A guest walks into a five-star hotel and pays $1,200 for one night. Before leaving, they spend another $180 at the restaurant, $250 at the spa, $90 on valet parking, and $70 at the bar. One guest, one night, nearly $1,800. Now imagine 200 rooms. From the lobby, this looks like one of the most powerful businesses in the world. Marble floors, expensive cars outside, weddings every weekend, celebrities at the bar, and rooms selling for more than many people earn in a week. But here is the contradiction. A five-star hotel can generate more than $50 million a year, look completely successful, and still leave its owner with almost nothing. Because the person whose name appears on the building may not own it. The company operating it may get paid before the owner does. The bank gets paid whether the rooms are full or empty. And at midnight, every unsold room disappears forever. You cannot store tonight's empty suite and sell it tomorrow. The inventory dies every night. Today, we are opening the financial file on a five-star hotel, what it costs to build, where the money really comes from, who takes their share first, and how a property full of paying guests can still become a financial disaster. Before we open the books, subscribe if you enjoy discovering how glamorous businesses really work behind the scenes. Let us build a fictional 200-room luxury hotel. The first shock is the construction cost. According to HVS's 2026 U.S. Hotel Development Survey, the median cost of developing a luxury hotel was more than $1.6 million per room. That includes far more than beds and bathrooms, land, structure, public spaces, kitchens, mechanical systems, design, furniture, financing, and pre-opening expenses. At that benchmark, 200 rooms represent more than $320 million. And that is before the first guest asks for a room upgrade. The owner may spend years securing land, approvals, and financing while the building produces no revenue. HVS notes that hotel development commonly takes 3 to 5 years. During that period, construction prices can rise. Interest accumulates. Designs change. Permits are delayed. Every additional month costs money, but the hotel still has no guests. Before opening, it must also recruit staff, stock the kitchens, install systems, launch marketing, and hold enough cash to survive the opening period. So the first wow moment is this. The hotel can begin losing money years before it sells its first room. Most guests assume the famous brand on the building owns the hotel. It does not. A luxury hotel may involve 3 separate players. The owner owns the real estate, supplies the equity, signs the loan, and carries most of the financial risk. The operator runs the daily business. The brand supplies the name, reservation network, loyalty program, marketing system, and operating standards. This structure explains one of the most important secrets in the hotel business. The brand can make money even when the owner does not. Marriott describes its business as fee-driven and asset-light. At the end of 2025, its system covered nearly 1.78 million rooms across more than 9,800 properties, while its growth model continued to rely heavily on management and franchise relationships rather than owning every building itself. The brand sells access to its name and system. The owner builds the property, maintains it, and survives the debt. The sign above the entrance is an asset. The building underneath it is a liability until the numbers work. Our fictional hotel has 200 rooms. That gives it 73,000 available room nights each year. Suppose its average daily rate is $650 and its annual occupancy is 70%. The hotel sells 51,100 room nights and generates approximately $33.2 million in annual room revenue. That sounds excellent. But hotels do not judge performance using room price alone. They use a metric called RevPAR, or revenue per available room. A $1,000 room rate means little if most rooms remain empty, while heavy discounting can fill the building without producing enough profit. At a $650 average rate and 70% occupancy, our hotel's RevPAR is $455. Now notice how sensitive the model is. For this property, one additional percentage point of occupancy equals roughly 730 extra room nights. At $650 each, That represents approximately $474,500 in additional annual room revenue. One occupancy point can be worth nearly $500,000. That is why hotel prices constantly change. A suite might cost $500 on a quiet Tuesday, $1,100 during a major conference, and $2,000 on New Year's Eve. The cost of cleaning the room barely changed. Demand changed. Once the building is open and staffed, selling one more room can contribute meaningful cash. But the opposite is brutal. Every empty room becomes worthless at midnight. A supermarket can sell yesterday's inventory tomorrow. A hotel cannot sell yesterday's night. Rooms are usually the economic foundation, but luxury hotels try to monetize every hour of the guest's stay. Restaurants, bars, room service, spas, parking, resort charges, retail, and upgraded experiences all create additional revenue. Then come conferences, banquets, and weddings. A ballroom can generate rental, catering, service fees, parking, and guest room bookings from one event. Imagine a 500-person wedding spending $250 per guest on food and beverages. That's $125,000 from one wedding. And that is before adding accommodation, ballroom rental, parking, decor coordination, premium drinks, and other services. Now let us complete our fictional hotel's revenue file. Rooms generate $33.2 million. Restaurants and bars generate $12 million. Weddings, conferences, and banquets generate $6 million. The spa, parking, retail, and other services generate $3 million. Total annual revenue reaches approximately $54.2 million. This is where inexperienced investors see $54 million entering the property and imagine the owner becoming rich. But revenue is not profit. And inside a five-star hotel, almost everyone touches the money before the owner does. Luxury service is expensive because luxury is mostly labor disguised as comfort. Someone cleans the room, parks the car, cooks the food, repairs the building, manages the wedding, watches the cameras, and solves problems at 3 in the morning. Many of those costs continue even when occupancy falls. HVS says labor remains the largest expense line in a hotel profit and loss statement, and that rising labor costs have become a structural pressure rather than a temporary problem. Food and beverage creates another illusion. A busy restaurant looks profitable, but ingredients, labor, equipment, utilities, and waste absorb much of its revenue. CBRE found that hotel food and beverage departments in its sample produced a 29.1% departmental profit margin during the first half of 2025. Labor alone represented 59.4% of departmental expenses. Now follow the money through our $54.2 million hotel. Room department expenses consume $8.3 million. Food, events, spa, and other direct departmental costs consume $14.6 million. Administration, sales, technology, utilities, repairs, and general operations consume $9 million. Brand, reservation, and management charges consume $4 million. Property taxes and insurance consume $3 million. A renovation reserve consumes another $2 million. The property now has approximately $13.3 million remaining. That is before debt service, income taxes, depreciation, and certain owner-level costs. The hotel is busy. The lobby is full. The restaurant has a waiting list. The owner may still be in trouble. A global brand can be extremely valuable. It may bring loyal customers, corporate contracts, international marketing, trained operators, and a reservation system that fills rooms during weaker periods. But the brand's help is not free. HVS reports that hotel management companies commonly receive a base fee equal to 2% to 4% of operating revenue, with 3% being the most common, plus possible incentive fees tied to performance. Shared service charges may also cover centralized marketing, reservations, and technology. Here is the conflict. Many fees are calculated from revenue near the top of the income statement. The owner receives what survives near the bottom. If our hotel produces $54.2 million in annual revenue, A 3% base management fee alone equals approximately $1.6 million. That payment can exist before the owner receives $1 of cash return. Now add franchise royalties, loyalty program costs, reservation assessments, marketing charges, and required upgrades. The brand may be performing well, the guests may be delighted, and the owner may still lack cash because the bank is waiting. Suppose annual principal and interest payments total $15 million. Our hotel had $13.3 million left before debt. After debt service, the owner is approximately $1.7 million underwater. A hotel generating $54 million in revenue has become a business that requires more money from its owner. That is the central contradiction of luxury hospitality. Full rooms do not guarantee a wealthy owner. They only guarantee that the machine is moving. If the operation is this difficult, why would anyone invest hundreds of millions of dollars? Because the hotel is not only a business. It is also real estate. A hotel's value is often linked to the income the property can produce and the return buyers demand. Suppose a stabilized hotel generates $15 million in annual net operating income. At an 8% capitalization rate, the implied value is approximately $187.5 million. At a 7% capitalization rate, the implied value rises to approximately $214.3 million. The hotel did not add a room. The lobby did not become larger. The market's required return changed, and the theoretical value increased by almost $27 million. Owners may refinance, sell a partial interest, add residences, or sell the property after improving its income. This creates another wow moment. The hotel operation may struggle to make the owner rich each year, while the underlying property creates a fortune when it is refinanced or sold. In some luxury developments, branded residences can also help recover capital. HVS says residential components are increasingly contributing to the rising development cost and structure of luxury hotel projects. The rooms create the experience. The real estate may create the wealth. The greatest danger is not simply low occupancy. It is becoming trapped between luxury expectations and financial reality. A 5-star hotel must keep looking 5-star. Carpets age, restaurants lose relevance, technology becomes dated, and guests notice every service failure. The owner must spend money to protect the room rate. But spending money reduces cash flow. Delay renovation and the hotel may lose pricing power. Renovate, and it may lose rooms temporarily while taking on more debt. And unlike a budget hotel, a luxury property cannot quietly reduce service without damaging the promise attached to its name. HVS reported that hotel profitability was being compressed by a higher expense base, softer revenue growth, labor pressure, insurance, utilities, and other operating costs heading into 2026. This is the 5-star trap. The hotel must continue spending like a luxury property before it can continue charging like one. So, is owning a 5-star hotel profitable? It can be extraordinarily profitable. A successful property can produce tens of millions in annual revenue, generate valuable cash flow, appreciate as real estate, and become a landmark asset that wealthy buyers compete to own. But it is not passive income. It is a leveraged real estate investment wrapped around one of the most complicated operating businesses in the world. The owner may invest hundreds of millions of dollars, wait years for the property to open, employ hundreds of people, pay the operator, pay the brand, pay the government, renovate continuously, and pay the lender before receiving anything personally. The biggest lesson is not that 5-star hotels lose money. It is that visible luxury tells you almost nothing about invisible profit. A guest sees marble floors, expensive cars, rooftop pools, and $1,200 suites. The owner sees occupancy, payroll, debt covenants, management fees, renovation reserves, and a clock moving toward midnight. Because every night, the hotel must sell an inventory that will soon become worthless. And every morning, it must wake up and do it again. That is the economics of owning a 5-star hotel. And in the next video, we will open the books on another glamorous hospitality business where customers can spend hundreds of dollars in one evening, yet the owner may keep only a few dollars from every hundred. The economics of owning a luxury restaurant.